Find out how you could get 8%, 10%, or 15% or more added to your investment portfolio, like your IRA, Roth IRA, or that non-qualified account. Also find out how you can get guarantees and various protections within those account types and portfolios as well. So if you're someone who's in your 30s or even in your 60s, if you're someone who wants to retire earlier, wealthier, and happier, who values financial peace, financial confidence, and financial clarity, this is a must-watch video for you. Now, I'll have truth time on here, no BS, total honesty. Integrity is a huge part of who I am as a person and our firm, but we're gonna have real numbers, real facts from experts around there is, charts, illustrations, graphs, and so much more, so you can see the raw data yourselves on here. Now, what we're talking about are very, very particular types of fixed index annuities is what this video is gonna focus on as one tactical component in an overall portfolio that we have proven to help people retire earlier, wealthier, and happier, that have been used in the right situation, in the right circumstance by thousands of other people out there as well to also help them in that situation too. Now, I want to share a quote with you on here by William Sharpe. He's a Nobel Prize winner and creator of the Sharpe ratio. Described annuities as a potent and sensible instrument for managing retirement income and longevity risk. We'll have many other quotes throughout and charts and extracts as well. Now, there's another one, Robert Merton. He's the co-developer of the Black-Scholes model. He called structured tools like annuities a way to give individuals risk-free retirement outcomes, which we all want. We all want that risk-free, we all want protection, we all want guarantees so we can enjoy our lives of retiring earlier, wealthier, or happier. Now, my name is David Lumberg. I am a financial planner and tax strategist for over 10 years now. I do have 2 master's degrees and a certificate in financial planning, also a Marine combat veteran, and I'm also the owner of Awaken Financial Designs. And today we're going to be going over the fixed indexed annuities again in conjunction with the portfolio, because we are believers in stocks, in ETFs, in mutual funds, in real estate, and so much more out there. But we just know that fixed index annuities should be a considered tactical component in a plan if it is right for you. Now, let's look at this next chart here that's coming up. Now, on this next chart, we always wonder, hey, what about volatility? What about unknowns in the stock market? What happens if there was to have a crash or a correction? What protections could I have in place and what would my outcome look like? Because we don't want to have all of this stress. We don't want all of this fear. We want to have more confidence. We want to have more peace that's on there as well. So as you can tell here in this chart, it's giving you different examples on the far left over here to see, hey, if my portfolio was down X, in this case, we'll say 30% for a crash. Next column is the total return needed to break even. In this case, if it was down 30%, you need a 43% rate of return to break even. Now, the next side over here is the years to break even, assuming a return. So let's say on average, you no longer took any money out of your portfolio. Everything stayed as is. On average, if you had an 8% rate of return with that portfolio, it would take you about 4.5 years just to break even. Now, of course, in the far right, if it was up 12% and that was your rate of return, it would only take 3 years to break even. But of course, we want to go ahead and eliminate that stress and that fear as much as possible to give you a greater way to retire earlier, wealthier, and happier. Now, what we're going to be talking about is real talk on here, the pros, the cons, what it is, illustrations, charts, examples, and pure math and pure numbers so you could finally see what these really are and to say, hey, is this something I might want to have in my own life? Is this something I want more information on? We're just here to always give education and help people out, so always feel free to ask us questions as well. Now, I would greatly appreciate it if you would just like this below, if you would comment or you would subscribe. That way we can get out this vital information to as many people as possible out there, and spreading the education is key. Now, number one on here, what is a fixed indexed annuity? Well, let's go and look here. There is a leading expert. His name is Dr. Wade Pfau. And you can see on there, now he's a renowned retirement researcher. He writes extensively about fixed index annuities and raw mathematical forms and numbers and data to prove on there how it reduces the sequence of return risk, increasing income efficiency, and improving early retirement outcomes. His continued factual data is proof on how fixed index annuities, when implemented correctly, can be extremely beneficial in the right situation. Now, as we can see in this next image on here by Dr. Wade Pfau, and coming up, he's trying to say that fixed index annuities are an asset class. And so we want to make principal protection. They are competitive with bonds or can beat bonds, but net of taxes. Now, they are not a stock replacement. We're not trying to get 15, 20, 30% here. We're trying to get at least what bonds are getting, if not more. So we're kind of aiming for that anywhere that 5 to 8% annual rate of return, depending on a number of factors, in addition to some bonuses that can compound day one as well, which we'll be going over on here, anywhere from 8% to 15%, which we'll discuss later. Now, let's go ahead and move on here to our next section on here and say, what is a fixed indexed annuity? Well, an annuity, it's offered by an insurance company, so not by a brokerage firm, and it's an insurance type of product that you can have as an IRA, a Roth IRA, or a non-qualified account. Could even be joint form as others offered by insurance companies. That's why so many brokerage firms are on TV like CNBC or Bloomberg. You don't see them talk about annuities a whole lot because annuities are insurance type products, not brokerage products like stocks, ETFs, mutual funds, and bonds are. And they also offer you various ways for guarantees, various protections, different allocation choices, and different ways to grow your money. Now, of course, there are pros and cons, which we will be discussing on here, but if you could have at least some protections, why would you not? There's even some out there that might offer you a day one added value of 8%, up to 17%, called a bonus added to the account day one. Now, of course, there's pros and cons with that as well, but if you could have that, understand it, who wouldn't want an extra 8 to 15% added day one, understanding those risks involved with it? Now, there are leading other authorities on here, like Moshe Miskitz and David Blanchett, supporting integrating fixed index annuities in an optimized portfolio, especially when seeking guarantees and growth. Now, again, these are not linked directly to the stock market, but you might have an S&P 500 linkage on there. You might have a fixed account on there, a different type of bond portfolio on there. You can mix these allocations. Now, you're never going to lose your principal, as we'll see later on in some images here. So if you put in $100,000 and the markets were negative every single year, your worst case is the $100,000. Now, every 12 months of your own anniversary date, we'll see later, that you can go ahead and put in $100,000. Let's say it grows to $110,000. The $110,000 after your own 12-month period, that's locked in and guaranteed from future loss. So come year two, if the markets crash, you keep the $110,000. So you can lock in potential gains every 12 months as well as they occur. Now, common terms, commonly there is a 5-year, a 7-year, and a 10-year term, meaning that whatever term you choose, that all of your money cannot be taken out of that account until the end of that term. So the end of 5 years, end of 7, or end of 10, if you want to have 100% of your money out of it. Now, if you do take all of your money out prior to the end of those terms, there are surrender fees involved. Otherwise, if you understand it's one piece, and if you do want to withdraw some money out every 12 months, which we'll see later, you can have a withdrawal you can take out of these annuities without additional fees as well, which I'll show you on here. It could be for estate planning and legacy planning. It could be for IRA, Roth IRA, even a Roth IRA conversion protected strategy. So you can convert the IRA to Roth IRA in a protected guarantee matter and strategy over there without fear of loss occurring. Now, Dr. Wade Pfau again on here would say, fixed index annuities offer a unique combination, no downside risk, modest upside potential, and guaranteed income options. They're like a hybrid of safety and growth. Now, again, today is just fixed indexed annuities. There's a different type out there. It's called fixed income annuities. Now, it is something a little different. So today's just on fixed indexed annuities side we're looking at. Now, let's take a look at number 2 here on an actual case study or image. We can see that is on here. Now, this case study about adding a fixed index annuity to a portfolio. Now, there's a lot of conditions on here, but the return statistics for investments and structured annuity segments for 1 year. We have sources below there you can read as well, but you can see on the left, we have stocks, bonds, fixed indexed annuity. We can also see what happens on here on the far right-hand side, the probability of getting less than 0%. Well, with the stock, you could get a 31% chance of it going below 0. In a bond, there's a 23% chance it could be less than 0. In a fixed index annuity, there is 0% chance because you're guaranteed that principal protection and you're guaranteed not to lose anything. Now, in addition on here, the arithmetic mean, we see that bonds are at 3.8%. Fixed index annuities are at 6.1%. We can also see the compound return. The bonds have 3.7%. Fixed index annuities have 5.9%. So it's just showing you, hey, why not consider a fixed index annuity in lieu of a bond, or maybe a fixed index annuity as a mixture of ETFs and a bond in lieu of that? Or maybe you get the bonds, and in addition to bonds, you also have a fixed index annuity separate on top of that. These are options to be aware of because they can work. Now, Roger Ibsen, economist, funded and index annuities outperformed bonds from 1927 to 2016 and added smoother returns through down markets. This is a leading economist who just said from 1927 to 2016, fixed indexed annuities, they offer greater returns than bonds. Now, example on here, let's take a look here to say, hey, the market's dropped 30%. What happens to me? Your worst case is zero. Remember that. So there's no panic selling. There's no delayed retirement. There's no sleepless nights. If you retire earlier, there's no going back to work on there. And you don't have to worry about these anymore because you have that peace and you have that protection that can happen. Now, another famous person on here is Tom Hegna, a fixed index annuity. It's the peace of mind retirees crave to have. We don't want fear and stress to occur, especially if you retire earlier as well or you're in retirement and you're older. Now, you've worked so hard. The question is how much I can grow. It's how much I can protect. Let's look at a real illustration here on a hypothetical client example. Again, example only, but a real illustration to show you what exactly these do look like. Now, as the first one's going to come up on here, we're going to look at the hypothetical, and then I'll show you the guaranteed directly afterwards here as well. Very crucial to see both. So on this hypothetical, non-guaranteed basis or example only, this person put in $50,000. Again, IRA, Roth IRA, non-qualified account, started at $50,000. They got a 9% bonus, day one added to the $50,000. Starting value, $54,250. This is a 5-year term annuity. Now we can see on the far left over there, end of year at issue. We can see, go ahead, different years on there. We can go see the ages that are on there. Then we can see the contract values. Starting value, $54,250. Now we can see what happens here in the credit interest column. That little red arrow there, there's a 0%. Well, that year, the markets were negative on there. Remember, in a negative market, your worst case is a 0%. The following year, you got a 6% rate of return added to there, and you can see the contract value increasing. Next year, another 6% rate of return on there. Now that 6%, that is capped, meaning the most you can gain in any year is a 6% rate of return. So again, the most you can gain in any year is up to a 6% rate of return, in addition to that bonus you got, though, day one of 9%. Now, we can also see that as those accounts are going down, that contract value, you could see you don't lose any money because you're locking in those gains. So even in year 4, when those markets do go negative, you didn't lose anything from the prior year. And then it's in red. This is a 5-year term annuity. So at the end of 5 years, you could take all this money out and put it somewhere else. Now, let's take a look at the same thing. This is a guaranteed basis. Your worst case scenario, same situation on here. Started at $50,000. Again, IRA, Roth IRA, non-brokerage account. Get a guaranteed 9% bonus day one. Starting value, $54,250. Well, as you can see, the contract value stays at $54,250, but the credit interest rate is always 0%. Now, why? This is showing you that, hey, if the markets were negative every single year, your worst case is 0% every single year. And at the end of 5 years, your other worst case, even in crashes happening every year, you get to keep the 9% bonus no matter what. So you walk away with $54,250, assuming the markets are down every single year or negative that were occurring. Now, this is just one example of many. There's different tactics, different styles out there. There are different annuity types of structure these. It's just one example to show you that, again, we can use as a component in a tactical plan with those stocks, with those ETFs, with that real estate maybe, and so much more to, again, give you that peace of mind to help you retire earlier, wealthier, and happier on here. Now, annuities aren't about getting rich. They're about staying rich and living richly. Patrick Kelly, Stress-Free Retirement National Best-Selling Book Author. Now let's get this next image on here. Now this is going to be what's called a 10-year fixed indexed annuity. So 10-year fixed indexed annuity, non-guaranteed, hypothetical, example only. Again, IRA, Roth IRA, non-brokerage account. Starting value, $100,000. They give you a 15% added bonus day one to the account. So you start at $115,000. Now that contract value, you see first column, the added bonus is already there, $115,500. Again, the credited interest rate, first year is 0%. The markets were negative. You didn't lose anything. You just got a 0. The following year, you got a 6.25% return. Now in here, your cap, or the most you can get each 12 months, is 6.25% depending on market performance. You can see in those following years, some years you got the 6.25, but you can see most importantly in those red arrows, when there is a negative year in the market, you don't lose anything, you just get a 0%. Even better is you lock in those gains from prior years that might have occurred from future loss as well. Now at this one again, at the end of 10 years, you can go ahead and take all of that money out without additional fees on there. But again, you can withdraw money each year, which we're going to be covering later on here. Now, the next one, same thing. It's a guaranteed worst case scenario. Again, IRA, Roth IRA, non-qualified account. You put in $100,000, you get a guaranteed 15% bonus added day one to the value. You start at $115,000. Now you can see below here on there is the little extra on there. It's a little more of not 15%, but the contract value, $115,500. You can then see every single year it stays the same. The credit interest rate column is 0% every year. So if the markets were negative every single year, or if there's a negative return every single year, your worst case is a 0%. You can see at the end of 10 years, no matter what, you keep the bonus and you get the rest of your money on there as well in a worst case scenario. So again, there's another example. There are 5 years, there are 7 years, there are 10 years, and there's different ways to structure these depending on the situation. These are examples of what these certainly can look like on here. That's why retirees love this strategy. People that want to retire earlier love this strategy. 30s or 40s, you could utilize this as well in a different way. In your 60s, you want the protection on there. On this next image here, we're going to see a selection of outcomes from what's called the efficient frontier. Again, all mathematical data on here. Now what we can see on here is the portfolio return on the far left-hand side starts at a high number, 9.3%, and it goes down lower at the bottom to 4.9%. We can go ahead then and see this is a mixture on the right-hand side of three different assets: stocks, bonds, and fixed indexed annuities. You can go ahead and see the stock column. You have 100%, 0% bonds, 0 fixed index annuities. Now, as we move down on here, you're going to notice something interesting on here. The fixed indexed annuity side starts off at 15%, 30 to 46 to 61, but there are 0% bonds, and these are mixed with different portions of stocks on here. And those are always getting higher returns than the bonds being part of the portfolio as opposed to fixed index annuities. You can see in the very bottom down there, when you have bonds that are involved in conjunction, it's a lower return than having fixed indexed annuities that are involved in conjunction with stocks on there. Now you can also see that there's mixtures of having bonds and fixed index annuities with 0 stocks on there. You can see that return on there. You can see the return of having higher bonds or lower with higher fixed annuities or lower, but you can see on here it's mathematical that if you're wanting to have a choice between bonds or fixed indexed annuities, only based on the efficient frontier data here, that a fixed index annuity mix with stocks will get you a higher portfolio return than having bonds without fixed index annuities on there. So again, mathematical on here for you to see the numbers on how fixed index annuities can add greater value than bonds can, in addition to so many other benefits that we've discussed here as well. Now, the benefits on here again, IRA, Roth IRA, non-qualified account, could be a joint, could be a trust account on here. You have guarantees and you have protections on there, and it's also so important to know. Now, another leading book author on here, a known tax professional, Ed Slott, tax-deferred growth inside annuities can be a powerful engine for retirement. But structure matters. That's the key word. Structure does matter. It's not for everyone. How these are designed, created, implemented is the key to it, but when done correctly, they can be amazing. Now, what most advisors don't really tell you, I've been doing this for over 10 years now, and I've heard so many financial advisors just don't fully understand these. A lot of times it's because how they're compensated or paid. They might do the typical assets under management where they charge you percent to manage your stocks, ETFs, bonds, and mutual funds. But when you have an annuity, that leaves that account. So they're not able to charge you a percentage of management on that annuity that's out there or additional fees on that annuity that's out there. So a lot of times the advisor and that company and that business themselves, it loses money by giving out those annuities. Sometimes a miseducation, not a good understanding. Now, other times there are insurance-only agents who only sell annuities, and that's all they show you. They don't show it in conjunction with the plan, like stocks, ETFs, and mutual funds and bonds. So it's important to know, hey, am I talking to someone that wants what's best for me? Are they looking at all the pieces and all the tactics to ultimately say, hey, what is best for me as the client and not best for the advisor? That is what you want to have at heart. So if you meet someone out there who doesn't agree in fixed index annuities, after watching this video, I would ask them why to see what their thoughts are. Otherwise, share the facts with them on here. Now, again, don't ask a brother who's paid to manage your assets if you should remove assets from their book. Tom Hegna. Remember, you want that to retire earlier, happier, and livelier. That way you have peace of mind. Now, what to watch out for? There are so many pros and cons and so many conditions on these. You want to find out what is the cap rate. What are my participation rates? How much money can I earn? What are the different allocations or investments I can choose from? What are the terms of those on there? What are my surrender charges? So if I was to say get a 5-year, but year 3 I wanted to cancel the whole thing, what's my fee? If I had a 10-year, year 6 wanted to cancel the whole thing, what's my surrender fee on here? You want to know what the withdrawal strategy is, meaning every 12 months, you're typically allowed to take out 7 to 10% of the account value. So again, every 12 months, you're typically allowed to take out 7 to 10% of the account value without additional fees from that annuity while you have it for living on there. Now, transparency is what matters most. Honesty and always having integrity always does matter because you want, again, protections, peace, financial clarity as a component of your overall plan. That way, when you do retire earlier or wealthier or happier, you have this. Or maybe in your 40s even, and you say, hey, you know what? I have $300,000 in my IRAs and Roth IRAs. Why not have a piece of that be $50,000 or $75,000 of that $300,000? Put into a fixed indexed annuity structure correctly, have your other money, the other $225,000, still growing in stocks and ETFs. It's an overall cohesive plan that you can have even in your 40s as well. So this is just something that my team and I specialize in on the fiduciary financial planning and tax strategy. So if you ever want to meet with us, have questions, you can always comment below. You can schedule at our website at awakenfinancialdesigns.com. We're always here to help everyone out. And again, I would greatly appreciate it if you would like this, if you would subscribe, if you would comment below, tell me your thoughts on here, tell me what you think overall too. And then we also want to go ahead here and discuss everything overall for you. So thank you so much for being here with us today. As always, retire earlier, wealthier, and happier.